You're watching today's Daily Market Comment by Haralabos Pisuros. I'm Christina Marujos, and thank you for joining us at XM.com. The US dollar extended its slide against all the other major currencies yesterday after the March CPI data revealed that headline inflation in the United States slowed by more than anticipated. Moreover, the minutes from the latest FOMC decision showed that following the collapse of two regional banks, several policymakers were considering hitting the pause button. The headline U.S. Consumer Price Index slowed to 5% year over year, the lowest rate since May 2021, but the core rate ticked up to 5.6%. This is the first time since December 2020 where the core rate is higher than the headline, confirming the notion that the slowdown in headline pressures is more likely due to volatile items like energy. That's maybe why investors kept firmly on the table bets that another rate hike may be needed in May, and still price in more than 50 basis points worth of rate reductions by the end of the year. With the European Central Bank expected to deliver around 75 basis points worth of additional rate increments without pressing the cut button at all this year, euro-dollar may be poised to continue drifting north. All three of Wall Street's main indices closed in the red despite the miss in the headline CPI and despite the minutes of the prior Fed meeting revealing that some officials wanted to stop raising rates. As soon as the inflation numbers were out, the S&P 500 jumped but hit the key resistance territory of 4150 and pulled back, extending its retreat after the minutes were released. Investors will now lock their gaze on the earnings season for Q1, which kicks off on Friday with results from major banks. Gold continued to be the safe haven of choice in this environment, benefiting not only from the dollar's weakness yesterday, but also from the retreat in Treasury yields and worries about the state of the U.S. economy. The metal got closer to the high of April 5th, a break of which could pave the way towards the $2,070 announced zone. The Bank of Canada decided to stand pat for the second meeting in a row yesterday. However, it did not satisfy those expecting a cut later this year, with a statement revealing that policymakers are still prepared to raise rates further if deemed necessary. Nonetheless, investors are still seeing a 25 basis points rate reduction, meaning that although the loonie may continue performing well against its U.S. counterpart for a while longer, it may resume its slide against currencies whose central banks are expected to continue raising rates without cutting, like the euro. In simple words, the euro-loonie uptrend may resume very soon. Thank you for watching the Daily Market Comment here at XM.com.